So friends, today in this video, I'll be comparing some of the financial products belonging to the Canadian banking industry vis-a-vis to the Indian banking industry, with special emphasis on day-to-day banking, savings and investment. So what products do we have in the Indian banking industry? We'll start off with the retail products first, and in the coming vlogs and the coming videos, I'll be talking on more such products. So what are the type of accounts that we have which are in common with every bank in India? That is a current account, a saving account, and the most important investment avenue, that's a fixed deposit receipt, which we call FDR. So starting off with the current account, banks offer it to the business class customers and also to some small businesses which are operated in proprietorship concern. So talking about the features of the current account, there are no restrictions on number of transactions. That means number of debits and credits are not restricted. But a string which is attached is, it does not have any rate of interest. So that means you can deposit as much as you want, but the bank would not pay you any interest. Rather, they would charge for various services being offered in lieu of that account. Moving over to the saving account. This is a class of an account which is called as, which can be offered in various forms: a general saving account, a small saving account. What is the objective? Usually salaried class people, the employees of a particular organization, would opt for such kind of an account, wherein although there are no restrictions, but still the debits and credits are restricted as compared to the current account, and you are usually paid a rate of interest on the deposits which you have. Earlier in the Indian economy, the interest rates were touching 4-5%, but recently it has come down to 2.5, 2.75, depending upon what sort of balance do you have in your account. And you would also come across various, private sector banks, some new entrants into the Indian economy, which might offer you a higher rate of interest going up to 6-7%, again depending upon the balance which you are maintaining in your account. So that's your general saving account. Moving on to the investment part, I would say the fixed deposit receipts, or FDRs, has always been a very hot selling product as far as the investment is concerned. It's a debt kind of an investment wherein a customer puts in some money, locks it for some time and earns a rate of interest. So the rate of interest is going to vary depending upon the kind of deposit you have, the kind of tenure you have. An FDR is the most safest investment vehicle in the Indian subcontinent. Let's take an example. If you're putting 1 lakh to an FDR account, a fixed deposit receipt, that means you're locking your 1 lakh rupees depending upon the tenure you would like to have. For example, let's say you locked your FDR for 1 year and the rate of interest which is given to you is 8%. So that means after compounding, you will get something more than 8,000 after 1 year. So this is how the lock-in works. And plus there is another benefit which, some banks give you. They can give you a loan against that FDR. So it's a very safe investment. And before the COVID thing, the interest rates were as high as 8, 9, 10%. But during COVID, the interest rates crashed like anything. After that, when the things improved, government started increasing the bank rate, and again the FDR rates have started coming up. Now the average interest rate, depending upon the bank, depending upon the tenure and the amount you put into your account, can vary to 6, 7 and 8%. So this is what FDR is all about. So now what we'll do is we'll try to compare these products with the products in the Canadian banking industry. I must say that the Canadian banking industry has actually streamlined, or I would say refined, these products as per their own needs. So the basic account that we have is a check-in account. Again, that account is meant for the salaried class people, or any individual who wants to take care of his day-to-day banking, income and expenditure, stuff like that. Although there are no restrictions on the transaction, but that would depend upon the type of check-in account that you have. A lot of banks have come up with various variants. So now it depends upon the monthly fee which the bank wants to charge. For example, if you have a check-in account with a lower monthly fee, they might restrict your transactions to maybe 12, maybe 15, 20, 25, 30, whatever the bank thinks fit for it. So the basic purpose of this account is day-to-day banking, income and expenditure. So usually banks are not paying any interest on the checking account. Through my research, I came across a lot of banks which might pay you some interest, but that's next to negligible kind of an interest. So it's not an investment kind of a product. Moving on to the next product, we have a saving account. Just like we have a general saving account in India, we have saving account in Canada. So the basic objective behind opening a saving account is, encouraging the client to save some money. So again, there are some restrictions on the transactions related to the saving account. That means if you're using your debit card or if you're using any other medium to take out money, it might cost you something. So banks usually here encourage the customers to pull out some money from the saving account transfer it to your checking account through the mobile banking, online banking, and then do a transaction. So usually, I've seen banks offering good high rate of interest on the saving account, which might range from 3% and can even go up to 5%. I've seen multiple banks coming out with promos, in order to attract some savings in the saving account. And the promos are like, for a few months, we can give you a high rate of interest. And after, that time period expires, it will again go back to its original rate of interest. So that's your saving account. So moving on to the third component, comparative to the FDR, fixed deposit receipt in India, we have guaranteed investment certificates in Canada, that is called as GICs. Now, again, we have some similar features between both the investment vehicles. First thing is, again, you have to lock some money. For example, you're buying a GIC for $10,000, you have to lock your $10,000 for the term you've opted for. It can be 1, 2, 3, 4, 5 years, depending upon the scheme the bank has. But a major, disadvantage, or I would say a distinguishing feature between the GIC and the FDR is, just in case you want to redeem your money, you will not be paid the interest by the bank. In majority of cases, the GICs which the banks offer you are non-redeemable. That means if you have a tenure of 1 year, make sure that you complete that tenure before redeeming the GIC. Unlike in the Indian economy, if you have an FDR, 1 year, you might take it out after 3 months, 6 months, or whatever time period you want the FDR to be in. You might be charged some penal charges on that, but you will be given your principal, along with the interest for whatever time period you parked your money in the fixed deposit receipt. So friends, these were the three products which, have some similarities or dissimilarities. So in my coming vlogs, we'll be talking on electronic banking, e-transfers, UPI, and few other stuff. Stay connected. Bye. Take care.